The economic survey for the year 2021 has been released and submitted to the Parliament. This economic survey is a prelude to the budget, which is due on the 1st of February. It reveals quite a few insights into what has happened and what is happening to the Indian economy. It also makes a few recommendations which the survey feels is a natural outcome of the crisis that has engulfed the global economy and the Indian economy in particular. That being so, there is a very strong recommendation to go in for fiscal policy management. That implies that there could be fiscal deficit increase. That implies that there could be a call to print more money as a way out of the current economic crisis brought about by the pandemic. And that is what we propose to discuss today. The backgrounders for the recommendation includes the fact that 90% of the countries are seeing falling per capita incomes in what is called a synchronized recession. A trade off, therefore, at least in the short run, is between health and saving human lives on the one hand and protecting the economy and protecting the livelihoods on the other hand. So, in view of the fact that first order supply disruptions have brought about demand shocks, the gross value added in the Indian economy is to grow negatively at 7.2% in the financial year 21, as against 3.9% in the financial year 20. There has been a steep fall of minus 23.9% in the first quarter and minus 7.5% in the second quarter of the financial year. Agriculture is perhaps the only sector which has withstood this pandemic and has grown positively at 3.4%. Industry contracted by 9.6%, a steep fall, and services 8.8%. The impact on services is likely to be even more because the hotel industry, the tourism sector, the banking sector are all going to take time and may well recover only in the financial year 22-23. That is the background. There are strategies which the government has tried to offset the COVID problems. On the health front, it was the 5T strategy: testing, tracking, tracing, treating the patients, and using technology effectively. That has somewhat helped India go forward with some degree of confidence. The government also had a four-pillar strategy for structural reforms in order to overcome the challenge of COVID-19. The four pillars are one of containment of the pandemic, bringing in fiscal measures, bringing in financial reforms, and then looking at the longer term horizon. All these strategies are expected to bring about a V-shaped growth as per the survey. Of course, one could contest whether there could be a V-shaped or a U-shaped, given that there is a K-shape with some industries growing and some industries falling negatively. But the survey feels that there is a V-shaped growth likely. The IMF endorses this viewpoint. It is worth noting that the IMF observed also that there could be an 11% real GDP growth in 21-22. But the survey points out that given that there is lack of private sector consumption and given that there is a lack of private sector investment, the government consumption will have to grow at 17% in order to power growth in the economy. That means that the government has to borrow. That means the government has to perhaps look to a greater measure of deficit financing, which effectively means that there could be an order to the Reserve Bank to print more money. Printing more money, the survey notes, can result in inflation. That's a theory that goes with us. There is a loss of purchasing power if in the increase in money supply is larger than the increase in output. However, the survey makes a strong case that if the increased money supply brings about an increase in output more than the money supply, then it is worth financing investment projects which have positive net present value or NPV, so that there could be a greater measure of growth, because the net present value of invested projects brings about returns, and these are more than the increase in money supply. Therefore, the survey makes a very strong case that there should be an increased money supply through the aspect of which are beneficial to the citizens. The survey points out that there is a possibility of the interest rate differential being less than the growth rate, and the survey feels that such a move is quite in alliance with the growth strategy of India. Negative IRGD, that is the interest rate growth rate differential, the difference between the growth rate and the interest rate is in India's favor. That is, there is a negative IRGD. That means that lower interest rates are not the reason for India's growth, but higher growth triggered. This is likely to bring about lower debt to GDP ratio, and that is likely to lead to higher growth further. Fiscal policy, therefore, seems to be very effective in countering the growth slowdown and the economic crisis brought about by the pandemic. The intellectual strength or the intellectual moving for such an argument is that the fiscal policy provides an impetus to growth more than the monetary policy. That the simulations undertaken by the government of India's finance ministry seems to suggest that till 2030, India's growth potential is very good, and therefore any debt borrower is sustainable. So the government as a borrower can borrow and invest in high net present value projects where the fiscal multipliers, one means by fiscal multiplier where the effect of the investment is maximum, and the argument is further strengthened by stating that fiscal multipliers are more during economic crisis than during boom. With a large number of people working in the informal sector, such counter-cyclical fiscal policy. One means counter-cyclical means contrary to the downswing seen in the wake of the crisis, measures by fiscal support to push up the growth rate will become even more important and may be beneficial to the informal sector. Therefore, multi-year, multi-pronged public investment packages will raise productivity and avoid or reduce the risk of falling into a low-wage growth trap, which has affected economies, even hard-working economies, even like Japan. The survey notes that the private sector is averse to risk. Therefore, somebody has to do compensatory investment or compensatory spending, and therefore, government has to step in both to consume and to invest. Such a process, the survey feels, will bring about a crowding in instead of the usual crowding out. Explaining that when one says crowding out, it means that if the government comes to borrow, the private sector has to pay a higher price because the sovereign risk is less, and therefore the interest rate for the government will be less, but for the private sector will be higher. Such crowding out is avoided, but in crowding in, government will lead the path through its investment strategy, multi-pronged investment, and where the fiscal multipliers are maximum. And therefore, the private sector will have an incentive as there will be growth in the economy. This is what is called crowding in. This is also exemplified by economies like the Gulf, where the government's revenues through oil trickling from the oil industry, the governments in the Gulf spend huge sums of money in investment projects, and that is what the private sector is looking forward to. So there is a lot of substantive evidence from the Gulf sector for crowding in, and that argument seems to stand. In doing so, that is in borrowing and spending through borrowing, the government may avoid delayed impact or economic hysteresis. Hysteresis means a delayed impact of the COVID pandemic. That economic prolonging the agony is avoided through such investment. So the survey calls for counter-cyclical investment by the fiscal authorities. This is not fiscal irresponsibility, it states. It is but an approach that is different from the usual anchoring that the GDP fiscal deficit ratio, or rather the fiscal deficit should not exceed 3% of the GDP. That intellectual anchoring seems to be asymmetric in the current situation. That bias has to go. There has to be a spending. There is a Keynesian thought here of let us start activating the compensatory financing through the public sector, and then growth will pick up in a sustainable manner. This is what the economic survey seems to convey most effectively. Thank you.